ladies and gentlemen, distinguished guests, welcome back. It's great to be here in person again at 121 Mining Investment London, and we really appreciate being able to put this show on again in person. Introducing our headline panel of speakers, I'd like to call to the stage Carl Tricoli from Denham Capital, Hans-Arne, who's head of metals and mining at Clarksons Platou Securities, Julian Treger, CEO at Anglo Pacific, and Philip Clegg, portfolio manager at Orion Resource Partners. Gentlemen, thanks very much for joining me. So the purpose of the opening panel is to hear from some of the leading investors and capital creators in the sector around some of the dynamics in the commodity market at present and where we might be headed as well. So, gentlemen, it's been a fantastic year, I think, generally for commodities as a whole. Strong pricing across the metals complex. What's been driving the investment thesis in the sector for now, and what do you expect coming in early 2022? Have we had such a high period? Are we expecting perhaps some corrections coming in the metals prices? Carl, sorry, perhaps I could start with you and we'll work our way down.
In terms of what we expect for 2022,
yes.
Well, I think we should start off just thematically with, I think, where all this is headed, which is the amazing, demand drivers that we have that are coming with this energy transition. And I think, as everyone knows, we can all sort of see a train wreck coming, which is these incredible forecasts around what's happening with electric vehicles, what's happening with wind and solar power, and all of the critical metals that are needed for those things. And so we're sort of going into that environment with, sort of 5 years of underinvestment. We're going to spend, something like $1 trillion of capex that we need by 2040 in order to reach this, zero carbon goal. And so right now we sort of have this gap between what the expectations are for the energy transition folks. Everybody came out of COP with these, great forecasts of where everything wants to go, but this incredible gap that we're seeing on the horizon in terms of supply, because we don't have the capital that's been spent to do the exploration that drives the projects. Just by to give some perspective here, by 2035, we need about an extra 15 million tons a year in copper, which is about 13 Escondidas by 2040, right? And you think about the time it takes to develop something like an Escondida and the time frame, so which is 15 years or something. So that's by 2040, which seems like a long time away, but it's really not. And so when we think about the scale of coming up with an extra 13 Escondidas by 2040, and that's just in copper, not to mention all the others, I think we begin to get some perspective on sort of what we're looking at here.
And so some of the outcomes from the COP meeting were a bit fragmented. I remember reading about some of the automotive OEMs not actually agreeing to a sort of set target date, BMW, one of them, and some of the larger, and Toyota, I believe, simply because they didn't believe in the emissions reduction targets within the time frame possible. This must be linked to sort of material supply. Do you think downstream purchasers and the OEMs are sort of realizing the scarcity of these materials and the supply side risks that they're going to create the challenges to suddenly switch to an all-electric fleet or switch to 100% renewable?
I think what you are beginning to see that on the downstream end users of those critical minerals and metals. That does not seem to be translating yet into somewhat the investor community. I think there's still underinvestment. Certainly in the public markets, it's still very difficult to obtain development capital to bring these mines online. So you're beginning to see the acknowledgement of these supply chain issues coming from end users that has not yet, I don't think, love to hear what my other colleagues here think, but that is not yet backed up into investor sentiment. supporting the mining industry in the way that it needs to. And it hasn't really filtered, honestly, into, when you look at the objectives coming out of COP, and I don't think that that's filtered yet into sort of the overall thinking about what's needed in order to accomplish this energy transition in the time frame that people are thinking about it.
Do you think global equities, beyond commodities, are being so performing so well? The S&P 500, etc. That's also sort of keeping some attention away from how well the commodities sector and businesses aligned to that have performed.
That's reflected in sort of the short-term prices of those commodities. Again, I don't think that that's translating yet into capital flowing in for development.
Yep.
But love to hear what these guys think on
Hans,
that topic as well.
Let's get your take.
I think number one, I want just to echo Carl in what he's saying about underinvestment in the sector. I think in general, the sector have been underinvested since 2012. And I think that's the major problem. I think the other major problem for the industry is the mandates and the policies around ESG, where this industry have a lot of work to do to be recognized that they are doing something on the ESG side. I think still that a lot of investors are underinvested in mining, and in particular in exploration and construction for new mines. And I think that's due to that mining is it still looks like being brown and bad in a lot of views. So I think the industry have to move ahead and tell what they physically are doing to sort of take down the carbon footprint. When it comes to the mineral prices and what's in front of us, it's always going to be bumpy. This is a cyclical industry, and I do believe that the investors is running ahead of the industry on where they're putting the money. Philip and myself have seen that people that was early in the cycle for lithium certainly get problems, and now lithium is on all-time high again. And I think that's the other signal that you should take very care of. It's going to be bumpy, it's going to be cyclical. What we see from where investors are is really that at the moment it is focused on electrification and the big investment that the OM in the car industry have done in their infrastructure. E.g., Volkswagen have invested more than 32 billion euros for making electrical cars and EVs in Europe, and equally more in China. But no one have followed where is the feed for the batteries going to come from. And Clarkson's view at the moment is probably that nickel is number one of the shortest going forward, and probably graphite the second one, where the underinvestment are largest for the time being. But I think the industry and people that are sitting here and all the companies, you should really think and be not messaging or greenwashing your story. You should really do something with it from day one. Investor will accept higher capex if you comes out with a lower sort of carbon footprint. So I think that that's the major message. The industry have to be recognized as cleaner to attract all the money needed.
Yep, certainly. So do you see metals prices sustaining into next year, given supply shortages, and particularly in nickel, graphite that you mentioned, and this sensational demand that Carl's also described on top, particularly in the electric vehicle, the battery metals complex?
It's a mixed picture, but in general, we think that battery mineral is undersupplied up until at least 27. So we think that the price is going to stay high for a while.
Okay, excellent. Julian, let's get your take.
Yeah, I mean, clearly there is a great bull market in battery metals, and certainly the PR around battery metals. But obviously, if you look at the last year and you look at next year, the main driver of pricing volatility of commodities is going to be China and its domestic policies. I mean, if you think about what happened with iron or coal or copper sales from the reserves. That's really, it's all about China. It continues to be a macro story in the very short term. And honestly, you'd have to have insight into Xi's brain to predict what commodity prices are going to do next year. And we can see how it varies. Australia can be booming in one area and be banned in another area. It's a very tricky story. But I think in the longer term, I wouldn't get too carried away about the hype around electrification. I think the fact that we're all sitting here today, just having gone through this, terrible experience with COVID, yet human ingenuity created incredible vaccines and cures in a very short period of time. I strongly believe that creativity will produce solutions to these shortages. I'm already seeing, like new alloys which mimic, for instance, copper, but at much lower costs. And I also think that there's going to be a much stronger bull market in recycling and reprocessing than in primary mining in the next 10 years, because that's the way in which the supply can be produced in a relatively short period of time, quicker than getting new mines up and running. So I think there are going to be a number of interesting dynamics which need to be pursued as investment opportunities.
Yeah, it's interesting. Thinking back to the energy crisis that we've just had, it's not simply a switch to renewables. There's clearly a lot of flaws with just sort of dropping things like coal, for instance. It's going to be a broader and more protracted switch over in this energy transition. And you mentioned China, of course, who are leading it in terms of the controlling of supply. What's your take on sort of Europe and some of the mandates that have come out of COP, EIT raw materials, and some of these, and the US Critical Minerals Act, trying to claw back a bit of the supply chain, invest in mining projects, and really get into the critical minerals that they've neglected for quite a few decades?
Yes, so I think that is definitely a contributor to demand. So we used to live in a globally connected world where there was just-in-time global supply chains. And it's clear over the last couple of years that those have broken down, and we have the Chinese supply chain. The US is trying to develop one, Europe's trying to develop one, and the UK is thinking about developing one. But those are by definition much more inefficient, and therefore you'll need stockpiles in each country. The costs associated with not being global will be higher, and therefore I think that is an interesting dynamic. One of my thoughts is that waste will be seen as the national heritage. The fact that we used to send our rubbish to Bangladesh or Gambia will be seen as the most ridiculous thing in 50 years' time, and it will be seen as our national asset, which we need to keep within our countries and recycle and maximize the value of.
Yeah, certainly. I mean, all mobile phone countries want your old models, that kind of thing. But recycling, it needs a lot of work. It's a fraction of the overall supply of minerals, and it's quite inefficient from my basic understanding. Is that right?
I think it does vary tremendously between commodities. So I think there's already quite a lot of copper recycling. Clearly, you can't recycle coal, although you can recycle coal waste. So it will vary, but clearly it's going to be part of the answer. It's not by any means the full solution.
Philip?
Yeah, just add to that, actually. I think that it's becoming a fairly significant trend, recycling. There's a number of companies which have cropped up over the last year or so. There's one called Lifecycle, which there was a SPAC transaction for a few months ago, or the beginning of the year, actually. And the valuation was just literally insane. There's a company that has got a revenue of about $1 million a year, and I think it's SPAC'd at $2 billion. So it's quite sensational. So the point I wanted to make on that is that there is definitely appetite in the investment community for this kind of stuff. If I think about what the LPs of Orion are telling us to do stuff connected with decarbonisation, do stuff which with companies which have got best-in-class ESG. So it's all about responsible investing now. And I think that's what we'll see in 2022 and for the next few years. A bit more context, actually. So We actually IPO'd our first SPAC a couple of weeks ago in a fairly mediocre market for SPACs, actually. And it was 5 times oversubscribed. And the reason why it was 5 times oversubscribed was because it's entirely focused on decarbonisation.
Yep. So this is the thematic. What does that mean under the hood? Does that mean that you're going to be touching junior mining companies that have struggled to get this capital, as we've heard? You know, there's still fundamentally an underinvestment or perhaps a lack of appetite from more generalists that are funding juniors.
Well, I think that there's certainly appetite from our side to make investments in the space. I mean, we've actually been doing it for a number of years, right across the commodity spectrum. Like I always say, that's one of the wonderful things about mining is there's so many commodities in which to invest. And if you think about decarbonisation, energy storage, electric vehicles, and renewable power, you've got nearly a dozen commodities which are directly linked to that. So from our perspective, you know, we're open for business and looking to make investments, you know, in this thematic, which is the thematic of a generation.
Yep. It's the defining theme of this century in terms of the energy transition. But yeah, in terms of the companies then, let's work our way back across. How have they been performing in your view? Is it quite fragmented? Are these ESG narratives and pieces coming through really strong? Are you seeing, you know, aside from just the fundamentals, are they speaking to the ESG consensus very well?
Yeah, I think it's embryonic a little bit at the moment in terms of the way that mining companies think about ESG, particularly junior mining companies. And you know, how often do you see a sustainability report from a junior mining company? It's not actually that frequent, but it's happening more and more. And you know, there are a couple of companies in our portfolio which are doing it, you know, pre-production companies, and those that do it actually attract, you know, that incremental investor, both in terms of equity investors, but also in terms of attracting debt capital as well. So a couple of our portfolio companies have got incredibly cheap debt finance. And one of the reasons that they've managed to do that is because of best-in-class ESG practices that they put in place years ago and have continued. And they, you know, one of them in particular I'm thinking of did that for the very reason that they knew that they wanted cheap debt capital from a bank with long tenor. So there's financial benefits for, you know, best-in-class ESG practices.
Yep. Julian, we'll work our way back down. How have the companies performed? Not just your portfolio companies, but how has the junior mining tier performed over the last year? And are there any areas, particularly on ESG, that are sort of improving on, enhancing on in terms of that communication piece?
I mean, I think it has been very much driven by commodity in terms of the share price performance. But in terms of, I mean, everybody's getting on the same message at the moment. And I think, everybody's understanding that they've got to get their act move up a gear. And, you know, as royalty companies, we are putting pressure on all our portfolio businesses to report better, to be more responsive. And so the message is definitely getting out.
Yep. And what about this decarbonisation piece? How is that feeding into your business and the investments that you make?
Well, again, I think everybody's, got to step up another stage and, be much more granular in terms of the way they report on their carbon footprints, scope, all the scopes. So I think it's moving. I mean, the question is it moving fast enough for the world? And I think generally the consensus is that we're still going a bit too slow. Right. But hopefully, it's the first steps and then there'll be more acceleration.
Is that because of the task at hand, sort of working it out, sort of feeling in the dark for what are these new reporting standards,
Well, I think the reporting standards, etc., are just a reflection of activity and a way to spend part of your bandwidth on thinking about solutions. So it's a manifestation of attention, but ultimately reporting is much less important than doing, and I think people are starting to do much more, and that is gaining acceleration. But there are, it's not happening fast enough. And I know there are now pools of capital being developed, particularly to tackle the difficult issues, like, for instance, cement. And so there are people who are thinking about, what else isn't being addressed and how to really focus on those things, even if they are tough to crack.
Yep, certainly. Hans, how have you seen the miners performing when you talk to investors? Are you championing the fundamentals as well as their other softer skills around ESG?
I think that what we have seen in the last 12 months really is great news for the audience of companies that want to develop mines. We have done construction financing across the board for different commodities, meaning that we have IPO'd and raised pretty large amounts in Scandinavia for iron ore, where the iron ore company really have done and is moving forward. And I think the important is not what you're talking about, what they have done, proven to have a very low carbon footprint. So that IPO performed extremely well. We have done a lot of construction financing bonds for different parts of the world. And we recognize that companies are challenged, but companies that are well prepared on the ESG side, they get funding for construction. And I think that what Philip touched upon on ESG reporting is correct for the policies of the investors. But when the investors really is sitting in front of the mining companies, they're asking what they are doing, what sort of equipment they are investing in, what sort of thoughts they have around safetiness, and what they do with their tailings and so on. So I would say that it's a very positive attitude across a lot of different, and it goes as far as I can see, even into met coal, that there is possible to finance that. Thermal coal, I think, is unfortunately for the general sort of capital markets gone. But for all other commodities, I think that if the management do proper investment in proper ESG, there is plenty of funds and there is plenty of investors that want to look. I think where the junior companies really have the biggest challenge is to get liquidity and size enough to get attention from investors on the equity side. I think still that's the biggest hurdle for early phase companies. And I think that we are meeting here physically, and that the companies that have great projects for the future is able to meet investors physically is going to be a criteria that you not can sort of fix on Zoom or Teams and so on. So I think that it's bright outlook for 2022 when it comes to financing of new projects.
Certainly. So more deal flow to come as we start to move around again and get face to face again. I hope so.
I think that we will see more deals coming for earlier phase or less advanced projects. 2021 have been great for the advanced project already, so it's difficult to see the capacity of the financial world to take more of those projects. I think the shift is going to be for the a bit earlier phase projects for 2022.
Okay, excellent. Yeah, we'll come on to that in a second, exploration as well. But Carl, just wanted to get your thoughts there on that decarbonisation piece in ESG, slowing capital down, or something that mining companies have built in sufficiently into their communications now?
So partly there's, I think, a perception gap that needs to be closed. And so, when I think about what in all of our portfolio companies, and in fairness, I think broadly speaking, most of the mining industry, in order to operate effectively, you have to have been responsible, right? I mean, in virtually all jurisdictions where you operate, having relationships with the local community or indigenous populations has been absolutely critical in order to be successful. Being a responsible environmental steward has been very, very important. So I think for a number of years, the mining industry has actually been doing this. In large part, I think though that there is a perception gap of what people think about what extractive industries do versus what actually happens on the ground. And so I think it's important for the industry to be cooperative with other organizations so that people understand how mining can be done responsibly. And then in addition to that, the industry is putting a lot of effort into performing these operations with a lower carbon footprint. And so all of these things need to be effectively communicated, because again, back to what I was saying earlier about this gap, there is this issue with having a problem with the mining industry and extractive industries, while at the same time that's incredibly important for this energy transition. Hans, you were talking about metallurgical coal, for example, where we're seeing actually a complete withdrawal, where people sort of lump metallurgical coal in with thermal coal, and people just want to be able to tweet, "I don't invest in coal," right? And the issue is about 40% of the content of a wind turbine is metallurgical coal. About 25% of the content of a solar panel is metallurgical coal. So there is no energy transition without metallurgical coal. And I think that's an example of this sort of perception issue of, what people need to recognize that the mining industry contributes versus what the reality is. So
is it improving though at all? I sort of hark back to when we were doing physical events before, and you've got things like Musk tweeting about nickel and things like that. Now the EVs, everyone knows what an EV is now, and you've got Volkswagen doing their D-Day, Tesla Day. These are sort of helping permeate the idea behind what's in a battery into people's minds a little bit better. Have you seen it improve at least over the last couple of years?
It is just beginning to improve. And again, I think we need to move, this is an editorial comment, but I mean, we need to move from, sort of virtue signaling, checking boxes, to having very thoughtful conversations, because everyone agrees on the need for decarbonization. Everybody understands climate change and the things that need to happen, but there are realities associated with that. There are realities around how rapidly that can happen. There are realities around supply chain issues that that we need to get together. Now, how that relates to us and the industry is we have our work cut out for us. And so we're talking about recycling. So the 15 million tons that I cited is actually net of recycling, for example. When we look at developing nations where a lot of demand is going to come from, they actually don't have the pool of recycling materials that the developed world does, right? And so when you look at the biggest demand centers, which are the developing world, they don't actually have, the material to recycle as much as the developing world does. So I think what all of this means is that, like everyone here has mentioned, Denham has capital to put to work, to invest in the sector. And I think we have to be diligent about communicating effectively on ESG, communicating effectively on what the industry needs to contribute, because we're very, to answer your earlier question, we are very constructive on these prices, because when we look at the fundamentals around supply chain versus what's coming, these are cyclical industries. There'll be bumps in the road, but generally speaking, over the next 5-year horizon, we're very, very constructive on these prices.
Yep, excellent. Okay, anyone want to raise a question at this point? We've got a roaming mic. If anyone's got a question for the panel, we've got one down here at the front, please. Can anyone run a microphone down at the front? Sorry, AV team. But if you want to pitch the question, I can repeat it. Oh, there you go. Perfect.
We have a roaming mic.
We've got one spare there.
Yeah.
Hello. Hi, good morning. Robert Mance from M2 Capital. I'd like the panel's outlook on lithium prices. The market, I think, is very, very hot. I think it's overheated. I'd just like to know the opinion.
Yeah. Anyone like to take that, please?
Yeah, I'd be happy to. Yeah. So I think I probably agree with that right now. I mean, we've got plus $30,000 a ton is a very healthy price when you think back just literally 6 months ago. But I think what you need to remember with lithium is that most lithium is priced off long-term contracts, right? The spot market is a tiny proportion of the overall market, and so where there's tightness in the market.
I absolutely agree with that. But retail investors will look at that number and go, "Oh my God, we're going to go to 50."
Well, that's a very bullish view. I think that there's definitely froth in the market. I mean, they've gone exponential over the course of the last month or so. So I would say, if in terms of the sort of medium term, I think they'll come back down. I think that if you look to the independent analysts, the sort of consensus price long term is going to be 15,000, maybe with slightly higher prices over the course of the next 3 years to incentivize supply.
Yeah, I think it has all the signs of a peak in the short term. I have a friend in Canada who's got a development project in the US, and he said in the last 24 hours he's been cold called by 3 brokers who would buy each to raise $30 million for him with a bought deal, which sounds a bit toppy to me.
I think it's a very interesting question, and I'm more than happy to give you a call on that. But I think the larger question here is really look at the price differential in market cap of Tesla versus GM. Because everyone says that Tesla is too expensive. It's all retail investors and blah, blah, blah. But the thing here is that what we see in the mining space as well is that new investors, young investors, retail investors, they don't want to invest in old industry that not comply with their view on ESG. And that's why you see Tesla being not sort of a car company compared to GM. They do the same technically, take you from A to B. But what we think, which we touched upon, and I think all of us have touched on it, this is an educational thing for this industry to, number one, tell investors and the society, what are we producing? We are not producing pellets or something. We are producing the material that can do the energy transition and to take down the carbon footprint. And if we can get that through, and we can compare more or less apple to apples, where we not have these peaks of Teslas or lithium and so on, we also will have a more consistent pricing of mining stocks. Because what the problem today is that they don't recognize what we are producing in the industry. So when we prepare companies to raise money, we're now trying and have done for the last 2-3 years, showing what is the end product. If it's a windmill or is it a car, is it a water cleaning system, and so on. And I think that's where the educational part of what mining is and produce is the big thing. Of course, as I said, we will have spikes, and particularly in tiny, small commodities. And when you have a tiny, small commodities like lithium, call it 300,000 tons or something like that last year. If you then have 5% of that as a spot market, of course, it spikes because you don't stop a car manufacturing from buying batteries if they need those 8,000 tons from Pilbara in the auction. So is it too high? Will it come supply when the price is as it is? Of course, it will come a supply on it. And the market will finance it because there's super profit today.
Okay, well, thank you for that. I'm surprised actually by your comment about the long-term price of 12 to 15,000. If you look at the brine market, and again, I'm not a lithium expert, and one of our other partners is. I think it's around 4,800. Is that fair? We just invested in a company called Lettuce Inc. out of Calgary. They're going to be they're processing at 1,500. So there might be trading opportunity there as the lithium price collapses in the next 6 months. We'll be posting a presentation on our website and releasing a press release so that it's not insider trading. Enchanté.
Very good. Thank you. Okay. Not much time left. Does anyone else have a question? Yep, we've got another one down here at the front, please. I'll run it over.
Thank you. Good morning. I would appreciate panel's view on uranium? One question. Second, all the brokers are talking about 10, 20 times increased demand for lots of these metals you were talking about, lithium, copper, et cetera, by 2030, when the governments are ordering 30% electric vehicle consumption. And my question is, from the industry, is it really realistic? Can companies actually manage to expand their production to achieve these goals? Because it takes 10, 15 years to get a copper mine into progress. So just wondering, what are your thoughts? You have mentioned recycling as part of the answer. So how this government or the green objective will be met if there actually isn't enough metals to be produced? Because I suspect that is the case. Thank you.
Well, yeah, I think harking back to Carl's point earlier around how many escondidas we need to provide the copper required for the energy transition, it's dramatic. But yeah, let's start with the uranium question, because I think that's quite interesting within the energy transition context. Is uranium regaining some kind of appeal? We've had, I think it was Rolls-Royce and a UK contract to do small-scale nuclear reactors. The decarbonisation piece, it obviously makes sense. Is uranium back on the scene?
Sure. We've actually never made an investment in uranium at Orion. I did at my last shop, actually, but I'm a believer. I think it's a crucial part of the overall energy transition, because if you think about wind and solar panel, the sun does not always shine and the wind does not always blow, and so you need stability in the energy system. So I'm a believer. What I would say, though, from a supply perspective, is that I've been taking a look at this recently, and in basically Kazakhstan, there's a couple of huge ore bodies there, which are basically extensions of these ISL, very low cost leach operations. And they can be brought on in the sort of 2022 to 2026 timeframe. So I think that, just as a general point, I think that the market can be quite well supplied in that timeframe. Beyond that, however, there's a problem. And so I think that a longer term, the uranium price is very difficult to predict. Just as a general point, come back to the same point I made a moment ago. It's a very small spot market versus the overall long-term offtake contract market. And so difficult to predict. But I think that in the long term, it's a decent bet.
I mean, I agree. I think uranium is definitely a solution. Hopefully there won't be another problem with uranium, because they do seem to have nuclear problems every decade. And people have forgotten about that in the short term. But if there is another one, that would really be a setback. Clearly, the short-term price is being manipulated by people trying to corner the market. That works for a while, but sometime you have to sell. And when those, huge amounts of uranium that various people have accumulated come back onto the market, the question is, how is the market going to absorb that? But absent coal, uranium is clearly a very clean, alternative to get to the carbon target. So it's definitely a prospective area
for the base load, and then you can support that with renewables when they're going or when it's sun shining.
Yeah, exactly.
Okay, Hans, did you have a view on uranium, or shall we move on to the other question?
Yeah, we have these discussions in Clarksons all the time, because we are so energy centric, and we're talking about hydrogen, we're talking about nuclear, we're talking about ammoniac, and we're talking about a lot of things. From a technical point of view, I think nuclear is the solution. But as we said, it's a small market for uranium, and uranium supply can be ramped up different places in the world. I think that what's the problem here is the long term. It takes so long time to really build sort of the reactors in a safe form with all the policies. So we are pretty hesitant to say that nuclear is the future, but it takes at least 10 to 15 years before you see a sustainable ramp up of the need for uranium and so on, because that takes a long time to get the political area regulations and building a really sort of material nuclear power industry. So,
price perhaps as well for the explorers and to start actually producing.
Yeah, and I think for the whole audience, we have to think about it this way, that sun and wind and what's called renewable, forget the big dams and electricity, but it is just 2-3% of the world's energy sort of supply coming from those industries. So even if they sort of grow with 20% or 40%, they cannot sort of outcompete fossil energy for a long, long time. It's a big question is, how can we do something to make the fossil industry more carbon or less carbon sort of emissions coming out of that industry today? I think that it's at least 3 or 4 different dual tracks to get the carbon emission down. And I think the largest sort of and shortest and best way is to have all the big energy companies like the Exxon and so on to really do something with what they are doing in their daily operation today. And secondly, invest in what we need for the long term. So it's not sort of either or, it's both.
Yep, excellent. Just comment on that Kazakhstan. Quickly, yes, yeah, please. We'll get you time.
So you comment about Kazakhstan uranium. Basically, the supply is driven by Kazakhstan and Cameco in Canada. They can switch it on and off. I lived in Moscow for 6 years. I covered Kazakhstan, Uzbekistan. I covered a number of countries. I worked for a couple of banks there, oligarch owned. I finished with PwC. Everyone wanted to go into Kazakhstan. I ended up dating a Kazakhstan oligarch's daughter, and his advice was, if you're going to come in here, you better have some serious Krisha. Krisha is the Russian word for protection. When these juniors go into Kazakhstan, Uzbekistan, whatever Stan Barty, you can't go in there. You need to, but please.
I'm enjoying this. Well, I'm actually not referring to that. I'm referring to Inkai 2 and Inkai 3, which are these massive ore bodies and extensions of Inkai 1, which is a JV with Cameco. And these ore bodies are controlled by Kazatomprom. So we've got a London-listed company, multi-billion-dollar company. They will develop this, and the capex is tiny. We're talking here about $200, $300 million for each of those massive ore bodies. It's just about wellfield development. And the operating costs of these ore bodies are incredibly low. Kazatomprom has got the bottom quartile of the cost curve, and it will extend that bottom quartile when these 2 assets come up and running. And because they can do that, they will do that when there is a need for the uranium. It will, as a consequence, keep uranium price, fairly modest, I think, until 2026.
Okay, 1 minute left. Just wanted to talk about exploration spend, really, and M&A or majors returning to growth. What as shareholders, lots of companies, what do you want to see from larger producers, or what do you expect to see? Do you think there's still a lack of capital going into exploration spend? Are we going to see more creative M&A coming in early 2022? What's the take quickly? Please, Carl.
So on exploration, interestingly, that's the one sector, particularly in the public markets, where we are seeing some interest on the exploration side. But there's going to need to be a lot more exploration spending. But we are beginning to see capital come into exploration. On the M&A side, I think particularly with the world opening back up, and so people can go actually do diligence and those sorts of things, I think we anticipate a pickup in M&A activity because, again, since you have had a lack of spending, of capex over the last 5 years, and as we move into increasing supply needs, what that will generally mean is that larger companies, even intermediate companies, are going to try and close that gap of production within their own firms through M&A. And so I think the combination of the fact that the world's kind of opening back up and people can go do their diligence, and the fact that companies are going to need to complement their production because they haven't actually been spending on exploration, means that I think you're going to see an acceleration of M&A activity in the next year or two.
Interesting. We've got 1 minute.
Yeah, I think what we see is still that the public capital markets will be difficult for exploration companies, but we do see quite a bit of investment from larger energy companies into exploration. So the companies should search for multiple sources. I think public market for pure exploration and small cap companies still is going to be challenging. The public market are looking for liquidity. So flip it around and look at what the Cebayon and Stillwater have done and so on. There is going to be a lot of M&A, and it's going to be a lot of M&A to transit the large typical sort of miners into energy transition companies and so on. So M&A activity will increase rapidly, but also investment from larger companies into exploration companies outside the public market.
Excellent. Okay, just a quick word.
I mean, lots of coal divestment.
Yeah.
That's clearly coming, but the majors, certainly in London, are in somewhat disarray from leadership perspectives, and so I don't think you would expect any super bold moves in the short term.
Okay, interesting. I think we'll leave it there. We're right on time, a little bit over. Thank you very much to my panelists this morning.